Welcome to Wise Man's Dollar, a podcast for everyday working people who want to make wiser decisions with their money, reduce financial stress, and build lasting wealth for themselves and future generations. I'm Sunjata, and I'm so grateful that you've chosen to tune in once again. So let's jump right in. In the last episode, we talked about how I structured my first dividend paying properly structured dividend paying whole life insurance policy, AKA my personal bank, and how I became and why I became my own banker. So, if you didn't get a chance to check that out, please go check that out. As I stated in that episode, that was a journey episode. I create episodes where I teach about different concepts around money management and whole life insurance strategy and infinite banking. And a part of teaching some of those strategies and concepts, I do episodes where I just share my personal journey within it. I try to weave those episodes in as well. So continue to follow along, give you a more, so you can see and hear a more personal, like how I'm implementing the lessons that I'm teaching in my life. I go into numbers, I go into my reasoning why I made the choices I made, etc. So I hope you get a chance to check that out if you haven't. In this episode, we're going to get into talking about the idea of why mutual insurance companies matter and the differences between mutual insurance companies and stock owned insurance companies. And I'm even going to share a few well known companies in both categories so that you can understand the differences. So, in a previous episode, we talked about why properly structured matters and what all that means. Well, again, with talking about mutual companies, we're really talking about like who you structure it with matters also. So, it's just important to understand. I don't think I didn't really understand that not all insurance companies were the same. And, it wasn't until I got into this space and started, educating myself that when I now when I hear the name like Mass Mutual or Mutual, et cetera, Life, et cetera, like I understand that when I hear that name Mutual in a company, what it truly means. And, it's not always in the name. All mutual life insurance companies don't always have that name, don't have mutual in their brand name, but several of them do. But I just thought they were all the same, but now I know they aren't. And with coming into this education, I realized that I needed to start asking some different questions. And one of those questions is, what kind of company should hold my financial foundation? Because again, if you've been following along, you understand that, I now believe and understand that properly structured dividend paying whole life insurance is an asset that is, at the foundation of my entire financial strategy. So, what company holds that foundation is so important. And if I'm going to be storing my capital there in the long term, of course, who runs it really matters and why they run it the way they do really matters. And it's also important to understand, and what I've learned is that company structure basically determines where the profits of that company goes. And that's really going to be the differentiator between the two categories of stock-owned companies and mutually owned companies. So let's get into those definitions a little more. So let's start with stock-owned companies. So, stock owned companies are insurance companies, life insurance companies specifically, that are traded publicly on the stock exchange and they're owned by shareholders, right? And what's the goal of stock owned companies that have shareholders? The goal is to maximize the profits of those shareholders for any company, and that includes life insurance companies. So, the profits generally flow to investors, right? Investors and stockholders. And the relationship with the policy holders is a customer relationship. They are customers of the stock owned company. Some examples that you may have heard of stock owned life insurance companies are MetLife, Prudential, Aflac, and Primerica. So, what about mutual insurance companies? So, the differentiators for mutually owned insurance companies are that they are owned by the policyholders, no outside shareholders. So, what that means is that profits generally flow back to the policy owners or members. They're called members, right? So, the profits generally flow back to those policy owners in the form of dividends, in the form of strong reserves. These mutually owned companies tend to have really, really strong reserves and high ratings amongst insurance companies, and they have very long term stability. And the relationship with the policy holders is a owner relationship. So they are serving their owners, they're not serving customers when a policyholder interfaces with the company. So, some examples of mutually owned companies that you may have heard of are Mass Mutual, Pacific Life, New York Life, State Farm. And I also want to give a shout out to another company that is not a company that you may have heard of because I hadn't heard of them, but the company that I have my bank with is a company called One America. And and just like the others, One America has been around for over 100 years, and they are a multi-billion dollar company, but they don't advertise in the same way that those other well-known companies are. But One America is one of the most prominent um, mutually owned companies in terms of working with infinite banking. So that's why my policy is with them. So again, it's really, really simple. Stock companies are for the benefit of stockholders and, outside owners are the ones who benefit, whereas mutual companies, members benefit. So remember that. So let me give you a real world analogy that I know is really going to help this, sink in. So we all know about the big banks in our country, the Wells Fargos, the Bank of America, the Chase, etc. And we also know that there's credit unions, right? So the same differences apply in that context, right? There's your local credit unions, there's the military-based ones, there's the teacher-based ones, the fire and police-based ones, and then there's just general neighborhood credit unions. Like the bank I actually bank with personally called Self-Help Credit Union. And the differences are the same. So the conventional banks are shareholder driven and the credit unions are member owned and they work for the benefit of their members versus the big banks work for the benefit of their stockholders, right? And their investors. So, one of the differences that I've noticed throughout my life with working with credit unions, and I've had money in both places, pretty much for the majority of my life. But more recently, I've stopped my relationship with the bigger conventional banks and only place my money with the credit unions. And some of the things I've noticed throughout my life, and one of the reasons why, when I was a young adult, people would always say you should check a credit union, like, for example, when I was going out trying to finance a car, check a credit union because they have better rates. And, or people would say, check a credit union because you should bank with a credit union because they have better customer service, etc. And, why is that? Because again, the customers are the actual owners. So there's just a different energy, there's a different vibe, there's a different feeling when working with credit unions throughout my life. And so I can take that experience into my experience in the life insurance space and understand that I'm experiencing a similar vibe, a similar energy working with a mutually owned life insurance company where I'm doing my personal banking in terms of becoming my own banker at this stage of my money strategy journey. So I'm sure several of you listening to this, watching this, have experienced those differences as well in the conventional banking context, whether you're working with a big bank like the Wells Fargo Bank America of the world or a credit union. So let's go into a little bit more detail about why this matters for infinite banking. One of the things that really gave me a lot of security with, deciding that I was going to put my financial foundation with a company like One America is understanding that One America has been around for, I said over 100 years, but really over 150 years. A lot of the original mutually held life insurance companies started over 150 years ago. And one of the things that really stuck out to me is learning that this company has made a profit every year for over 150 years. That means that through wars like Civil War, World War One, World War Two, etc., when there was so much upheaval in the economy, this company kept producing a profit and serving their members effectively through the Great Recession in the 1920s or 30s, right? Through all the various ups and downs in the economy, all the stock market crashes, like um, the Great Depression. I'm sorry, and more recently, 2008, 2012, between 2008 and 2012, the Great Recession. One America and a lot of other mutually owned life insurance companies have been performing and earning profits year in, year out, never losing money, and most importantly, paying their members, their policyholders, dividends every single year because they are very, very conservative in terms of how they manage their funds and invest their funds to ensure that they're going to be able to continue to perform and be stable. They bring a level of long-term strength and stability that is just unprecedented and unmatched in the money world. So that was something that really gave me a lot of assurances when I was deciding that this was a strategy that I was going to implement for my family, for myself personally, and then ultimately when I decided, this is a career that I would like to pursue to help other people do the same. So, you know, just really, really unique, just something that I learned. And especially in terms of, in the stock world, there's a lot of flashy, marketing, flashy talk about, oh, I can get this return. If I invest over here, if you go with this, superstar stock manager, you're going to get this type of return. And I mean, again, if you just look at the history, how many Ponzi schemes that have been, you know, um, enacted on innocent people and unassuming and people unfairly. If you think about the Bernie Madoffs of the world, et cetera, and there's been so many of them where people were, pulled into the allure of earning big returns on their money in the stock market. And how many stock market crashes have there been where you've heard of people who, lost their retirement because they just happened to reach retirement age at the wrong time? I am someone who has listened and has not forgotten that those things have happened. And that's why I've always been wary of the stock market. I'm just not a gambler, y'all. And I don't not people who are, okay, dabbling in that. And I know that there's a place for that in terms of how some people manage that uncertainty and manage that risk. But for those people who just like certainty, like me, or for people who just want to make sure that they have one bucket that is certain, dividend paying whole life insurance with a mutually owned company, whether you're doing it for banking or just a regular conventional whole life insurance policy, is just such a stable, asset to have a part of your portfolio. It's not flashy. There aren't huge returns, but what it does guarantee is uninterrupted growth year in and year out for the last 150 years plus and forever long for me personally, for however long I live. I love knowing that I'm going to get uninterrupted growth that's just going to compound and get bigger and bigger and bigger every single month basically. And that's pretty exciting. So one of the things I could say is that when building wealth, boring and dependable can be very, very beautiful. And that feels very wise. So, the way that that ties into a lot of the lessons that my granddaddy model basically was that, again, my granddaddy understood ownership and he was invested in life insurance. He also spread his money across several banks as a way to ensure a level of safety and stability. And he wanted to protect his savings carefully. And he watched very carefully where his money sat, how it was growing, and, he put it into very stable investments at these banks, like money markets and CDs. So he understood that where his money lived truly mattered. So here are the key takeaways that I want you to walk away from this episode with. Mutual companies are policy owner owned. Profits benefit members in the form of dividends when you're working with and partnering with a mutually owned company. Also, long term stability matters with the company that you choose for your financial foundation. There's a lot of internet companies out there. I see ads all the time on YouTube because I do a YouTube show now on life insurance. I get all these ads about this company or that company that has not been around for a long time. And believe it or not, some life insurance companies do go out of business. So make sure that you are partnering with a company that has been around for a long, long time and that is stable and highly rated. And also, alignment matters. If whole life insurance, specifically properly structured dividend paying whole life insurance, is going to be a part of your financial foundation, you want it built with a company that is designed to serve the owners, not outside shareholders. All right. So I hope that's beneficial. I hope you learned something new. And in the next episode, we're going to get into what I call the benefit series because properly structured dividend paying whole life insurance has 8 beautiful benefits that make it perfect as the foundation for your financial strategy and perfect for infinite banking. So, I'm going to do an episode on each of those 8 benefits, starting with the first one, which is the guarantees that it offers. So I can't wait to get into that and share starting out those guarantees in the first episode. And of course, in the first episode, I'll share all 8 that you can look forward to. All right. So thanks for tuning in to another episode of Wise Man's Dollar. This show is designed to spark curiosity about how people can take control of their money, relieve financial stress, and create intentional wealth using properly structured dividend paying whole life insurance and the infinite banking concept. If you would like to go deeper, visit go.factumfinancial.com /Sunjata, my first name, Sunjata. And you can find that link in the show notes, or if you're on YouTube, in the show description. And there you can get free access to a growing library of educational videos and resources about some wonderful financial and money strategies, like how to become a better saver, how to increase your liquidity, etc. If you enjoyed today's episode, please hit the like button, y'all. It will help other people find the show and really make my day. And also, don't forget to subscribe and drop a comment if you have any questions or you just want to share what resonated with you. And be sure to share this episode with someone else because wisdom grows when we pass it down. And remember, like my granddaddy always said, any man can make a dollar, but it takes a wise man to spend it. I'll see you in the next episode. Peace.